Stride Incorporated, ticker LRN on the NYSE. Founded in 2000 as K-12 Inc. by Ron Packard and Michael Milken, it began with a simple premise: bring a high-quality education to students who couldn't thrive in a traditional classroom.
Today, Stride is America's largest online K-12 education company, enrolling approximately 200,000 students through virtual public schools in more than 40 states across the country.
Pennsylvania and Colorado launched the first managed virtual public schools in 2001. By 2007, the company went public on the NYSE. By 2013, it had expanded to more than 30 states, becoming the dominant multi-state virtual school operator.
The pandemic was the inflection point. COVID normalized online schooling for millions of families who had never considered it. Enrollment surged over 50% in 2020, permanently expanding the addressable population comfortable with virtual K-12.
In 2021, the company rebranded from K-12 Inc. to Stride Incorporated, signaling a deliberate pivot beyond K-12 toward career and workforce learning for adult students.
The business model is simple and durable. 90% of revenue comes from state per-pupil funding, the same government dollars that follow every enrolled student. Parents pay no tuition. States pay regardless of economic cycles.
General education accounts for about 80% of revenue, generating $1.68 billion. Career learning adds $420 million, a segment growing faster than the core K-12 business.
The unit economics are compelling. Revenue per student runs around $10,500 paid by the state. Gross margin is 38%. Free cash flow hit $185 million in fiscal 2025.
The moat is multi-layered. 20-plus years of proprietary K-12 curriculum, adaptive learning technology, and student support systems create switching costs for the schools Stride manages on behalf of state education agencies.
Operating a virtual public charter school requires multi-year state approval processes. Every state Stride enters is a new competitive barrier erected against any entrant that follows. That regulatory moat compounds with each new state contract.
On the competitive radar, Stride leads peers in enrollment growth, revenue stability, and career learning mix. Its regulatory risk score trails because state politics can reshape per-pupil funding formulas with each legislative session.
Perdoceo and Laureate Education operate in adult higher education, adjacent but different regulatory regimes. Graham Holdings Kaplan runs a more diversified education portfolio. Stride's government-funded K-12 core has no true direct competitor at scale.
Stride serves students across more than 40 states, managing over 100 virtual public schools. 7,500 teachers and counselors deliver instruction across more than 3,000 subject courses.
The Career Learning Program targets IT, healthcare, and trade skills, high-demand vocational categories where employment outcomes are measurable, and the adult learner market is enormous and underserved.
James Ryu became CEO in 2020. A Columbia Law graduate who joined K-12 Inc. in 2014 as general counsel, ran the finance function as CFO, then stepped into the top role at the company's most critical strategic inflection point.
His legal and financial background anchors a capital-light model. Before Stride, Ryu spent over a decade at Weil Gotshal, advising on corporate finance and M&A transactions, discipline he brought directly to the career pivot strategy.
As CEO, Ryu accelerated the career learning build-out, pushed workforce training revenue past $200 million, and executed margin improvement from operating leverage on the fixed-cost education platform.
Stride turned a pandemic tailwind into a structural business. 200,000 students, 40 states, and a career learning arm that could be bigger than the K-12 core in a decade.
The fraud allegations are binary. If enrollment counts hold up, the earnings multiple is a gift. If they don't, every state contract is at risk. We dig into the numbers every quarter. Subscribe so you never miss a Charged Alpha deep dive. Stride traces its roots to the year 2000, when a company called K-12 Incorporated set out to answer a simple question: what if a student could attend a world-class school from anywhere without ever boarding a bus? That vision launched in Herndon, Virginia, grew into the largest provider of online public schooling in the United States, and rebranded as Stride in December 2020 to reflect a broader mission. Not just K-12, but career-ready skills.
Today, Stride runs two businesses inside one ticker. The first is General Education, publicly funded virtual K-12 schools across 40-plus states, serving roughly 134,000 students who log in every morning instead of entering a classroom. The second is Career Learning, career and technical education programs for middle and high schoolers, plus adult learners seeking credentials in technology, healthcare, and skilled trades through brands including Galvanize and Tech Elevator.
Stride reported fiscal third quarter 2026 results on April 28th, that is calendar January through March. The adjusted EPS beat, EBITDA beat, and revenue came in roughly in line. The company narrowed full-year guidance in a way that raised the profitability floor. Beneath the surface, though, there are two businesses moving in opposite directions. General education declining, career learning surging, and the question of which story wins determines the stock over the next 2 years.
CEO James Ryu has led Stride since January 2021. He joined the company in 2013 as CFO, then ran product and technology, then corporate strategy, so he architected the business before he ran it. He came out of Wharton and London Business School, held senior finance roles at Dow Jones, SiriusXM, and Match.com. He is a finance and technology strategist running an education company, and that shapes his thinking about long-term capital allocation over short-term margin management.
On the earnings line, Stride posted adjusted EPS of $2.30 versus the $2.21 estimate, a 4.1% beat. GAAP EPS came in at $1.93. The beat was driven by SG&A discipline. Selling, general, and administrative expenses fell 13.5% year-over-year to $102.5 million. Management cut overhead while investing in platform, a deliberate trade that helped protect the bottom line even as gross margins faced pressure.
Revenue for the quarter was $629.9 million, essentially in line with the consensus estimate and up 2.7% from a year ago. That modest headline growth masks a dramatic internal split. General education revenue declined 3.6% to $357.5 million. Career learning, middle and high school programs surged 15.9% to $259 million. The growth engine is clearly career learning. The question is whether it grows fast enough to offset the structural headwinds in the legacy K-12 business.
The most attention-grabbing number was gross margin, 36.8%, down 380 basis points from 40.6% a year ago. This compression is almost entirely self-inflicted. Instructional costs and services rose 9.4% year-over-year to $398 million, while revenue grew just 2.7%. Stride is spending ahead of the enrollment curve, treating platform investment as a future scalability bet. If the bet pays off, gross margins recover in fiscal 2027 as enrollment scales into the fixed cost base.
Despite the gross margin pressure, adjusted EBITDA came in at $171.3 million, beating the estimate of $164 million by 4.4%, a 27.2% margin. The beat came entirely from SG&A control. Stride essentially redirected overhead savings into platform investment, keeping EBITDA in line while gross margin compressed. That is not a sign of financial distress. It is a deliberate income statement trade, and management executed it cleanly.
Total enrollment reached 244,500, a new company record, up 1.8% year-over-year. Career learning enrollment hit 110,100 students, growing 11.6%. Career learning now represents 45% of total students, up from 41% a year ago. Revenue per enrollment rose 2.9% to approximately $2,485, driven by pricing and a mix shift toward career learning programs. The enrollment composition is moving in exactly the direction management has been targeting.
The strategic logic behind Stride's career learning pivot is straightforward. Virtual K-12 schooling was a pandemic growth story. Post-pandemic, enrollment normalized, states added regulatory friction, and the extraordinary growth faded. Career learning serves a structural gap. Employers cannot find workers with technical credentials, and students who cannot afford 4-year degrees are actively seeking alternatives. The addressable market is enormous. Stride is one of the few companies positioned to serve it at scale through publicly funded channels.
Stride's balance sheet is a genuine competitive advantage. As of March 31st, the company held $614 million in cash plus $192 million in marketable securities, combined liquidity of over $806 million. Long-term debt is $477.6 million, leaving a net cash position of roughly $270 million. Current ratio is above 6-to-1. For a company with a $3.7 billion market cap, holding $806 million in liquid assets represents a meaningful margin of safety. More than 21% of the market cap is sitting in cash and equivalents.
Operating cash flow for the quarter was approximately $120 million. Free cash flow after $36 million in capital expenditures came in near $100 million. Stride does not pay a dividend. Capital return flows through buybacks, with approximately $200 million remaining under the current authorization. At $89 per share, that authorization covers roughly 5% of the market cap. Management has the capacity to be meaningfully accretive on buybacks while still funding platform investment and potential career learning acquisitions.
The stock closed April 28th near $89, having peaked at $171.17 over the prior 12 months. That is a 48% decline from peak, not because the business collapsed, but because enrollment management decisions created perception problems, platform costs pressured margins, and education sector multiples compressed broadly. The 52-week low is 60.62. The stock has recovered from that trough, but remains deeply discounted versus where analysts think the fair value sits.
At $89, Stride trades at 11.35 times forward earnings and 1.54 times revenue. Enterprise value to EBITDA is 7.29 times, compared to the S&P 500 median above 14 times. Beta is 0.05, meaning this stock is almost entirely uncorrelated to the market and moves on company-specific news. That combination, cheap valuation, low beta, net cash balance sheet, high growth segment, is rare. The market is pricing in considerable uncertainty about margin recovery and enrollment, and doing so at a discount that appears excessive relative to the fundamentals.
Stride narrowed full-year fiscal 2026 guidance. Revenue now guided to $249 to $252 billion, and adjusted operating income raised at the low end from $475 million to $490 million. That $15 million raise on the profitability floor is management signaling confidence in the cost structure. Effective tax rate guided at 24 to 25%. Capital expenditures expected at $75 to $80 million. The guidance appears conservative relative to year-to-date trajectory. 9 months in, total revenue is already $1.882 billion.
The guidance conservatism is partly seasonal. Stride's fiscal year ends June 30th, so fiscal Q4, the quarter ending June, is historically a lighter revenue quarter as the academic year winds down. Q4 fiscal 2026 revenue needs to come in around $623 million to hit the guidance midpoint, which is slightly below the $630 million just reported. That is achievable on the current trajectory. The bigger question is what management says about fall 2026 enrollment when Q4 results are announced in late July.
Career learning is the business worth underwriting separately. Through 9 months of fiscal 2026, middle and high school career learning revenue has grown 22.1% year-to-date to $776.6 million. That is not noise. It is durable momentum in a market that is just beginning to be served at scale. Programs cover technology, cybersecurity, healthcare, and skilled trades. Employer hiring partnerships create a placement flywheel that drives both enrollment and outcomes. As placement rates stay high, word-of-mouth enrollment grows and marketing cost per student falls.
The one weakness in career learning is the adult segment. Adult learning revenue fell 31% year over year to just $12.9 million. The adult workforce upskilling market is sensitive to macroeconomic cycles. When hiring slows and economic uncertainty rises, discretionary training budgets contract. Stride has not provided a specific recovery timeline for this segment. At $12.9 million in quarterly revenue, adult is small enough that its decline does not threaten the overall story, but the trend warrants monitoring as an indicator of market demand.
Stride's competitive moat is built on regulatory barriers that took decades to construct. Virtual public schooling requires state authorization, accreditation approvals, and district partnerships. You cannot spin up a competing virtual school and immediately access publicly funded enrollment. The company has established relationships in 40-plus states that represent years of regulatory investment. On the career learning side, the Galvanize and Tech Elevator brands carry employer recognition and hiring network effects that took a decade of reputation building to accumulate.
The 48% decline from the 52-week high reflects three things: enrollment management decisions that depressed near-term results, gross margin compression from platform investment, and a sector-wide re-rating of education stocks as pandemic-era growth normalized. None of those three factors are evidence of permanent business impairment. The company is still generating $171 million in quarterly EBITDA, holds $806 million in liquid assets, and has zero net debt. The stock's punishment appears calibrated to peak pessimism rather than base case fundamentals.
Let's pull the quarter together before we go to the forward estimates. Adjusted EPS of $2.30 beat the estimate by 4.1%. Revenue of $629.9 million came in essentially in line. Adjusted EBITDA of $171.3 million beat by 4.4%. Career learning middle and high school revenue grew 15.9%. Total enrollment hit a record 244,500. Gross margin compressed 380 basis points to 36.8%. And management raised the adjusted operating income floor by $15 million for the full fiscal year.
The forward EPS projection, based on the updated adjusted operating income guidance midpoint of $495 million, implies full-year adjusted EPS in the range of $7.80 to $8 for fiscal 2026. At the current stock price of $89, that puts the forward PE at approximately 11 to 11.5 times. If career learning sustains even 15% growth into fiscal 2027 and general education stabilizes near current revenue, the earnings trajectory supports high single-digit EPS growth annually, and substantially more if the gross margin recovers toward the historical 40% range.
Analyst coverage on Stride is thin. Only 4 firms cover the stock. That limited institutional attention partly explains the valuation disconnect. Barrington Research and Canaccord Genuity both maintain bullish ratings with $125 price targets. Morgan Stanley holds a more cautious hold at $95. BMO Capital downgraded from buy to hold in October 2025 when enrollment concerns first surfaced, cutting its target from $164 to $82. The consensus buy-to-hold split is roughly 3-to-1 in favor of constructive.
The average analyst price target across the 4 covering firms is approximately $107, implying roughly 20% upside from the current $89. The high target is $125, Barrington and Canaccord, suggesting 40% upside if the career learning thesis plays out and enrollment validates. The low target is $82 from BMO. The wide dispersion in analyst targets reflects genuine uncertainty about the fall enrollment outcome, which is the binary event that will determine whether the stock re-rates toward the top or the bottom of the target range.
On insider activity, there are no open market purchases in the past 90 days. The primary activity consists of routine RSU tax withholding sales, the kind of mechanical selling that reflects compensation structure rather than a view on the company. CEO James Ryu has not purchased shares in the open market despite the 48% drawdown from the peak. The absence of discretionary buying is notable, though it does not override the fundamental case given the balance sheet strength and the pending enrollment catalyst.
With 4 analysts and a $3.7 billion market cap, Stride is underfollowed by institutional investors. Options activity is modest. Implied volatility was elevated into the earnings print given the stock's history of sharp post-earnings moves, then compressed after the roughly in-line result. The stock's 4% decline on the day itself was muted relative to the historical volatility. That muted reaction, combined with the 20% analyst target premium and the fall enrollment catalyst 90 days out, sets up a specific asymmetric opportunity for patient capital.
Education stocks broadly have been in a prolonged re-rating cycle. Post-pandemic enrollment normalization removed the extraordinary pandemic-era growth. Regulatory scrutiny of for-profit education adds a sector-level risk premium that gets applied even to companies with defensible revenue models. State budget uncertainty and changing federal education policy create headline noise. Stride is caught in this sector-level sentiment headwind, even as its career learning business executes well, and that disconnect between sector perception and company-specific fundamentals is precisely the opportunity.
Stride is not a for-profit college in the traditional sense. Its general education revenue comes from publicly funded virtual schools operating under state authorization, more similar to a charter school operator than to a traditional for-profit university dependent on Title IV student loan access. That is a fundamentally different regulatory risk profile and arguably lower than the sector comparison would suggest. Career learning adds market rate revenue that diversifies the funding mix. The sector discount the market applies to Stride may be structurally inappropriate given these distinctions.
Management has been consistent about the platform investment cycle. The thesis: spending on instructional technology and curriculum today creates scalable infrastructure that allows adding students at lower marginal cost in future periods. The 380 basis point gross margin compression is the price of that future scalability. If the thesis is correct, gross margins stabilize and recover in fiscal 2027 as enrollment scales into the fixed base. Every 100 basis points of margin recovery on $2.5 billion in revenue represents approximately $25 million in annual gross profit. That is a meaningful earnings lever.
School choice policy is a structural tailwind that does not appear in quarterly earnings reports. More than 30 states now have education savings account programs, scholarship tax credits, or school voucher systems, up from roughly 15 states a decade ago. These programs expand the eligible student population for virtual schools like Stride's. Federal interest in expanding virtual and career-focused learning creates additional authorization opportunities. Each new state approval is a new enrollment market. Stride is systematically expanding its regulatory footprint in anticipation of that pipeline.
Management's financial track record builds credibility for the guidance framework. In fiscal 2025, Stride delivered on full-year commitments despite enrollment headwinds. In fiscal 2026, the adjusted operating income floor was raised, a defensible signal rather than a headline move. RIU and CFO Donna Blackman have been consistent communicators. They acknowledge challenges, explain the trade-offs they are making, and tend to underpromise relative to eventual delivery. That pattern supports confidence in the current guidance range as achievable, not aspirational.
CFO Donna Blackman addressed fall enrollment visibility directly on the earnings call. The company is seeing strong demand as measured by application volume, and she expressed confidence in the long-term growth trajectory of the business. Application volume is a leading indicator, though not a guarantee. Some families apply and then return to traditional schools. Historically, Stride has converted applications at rates consistent with enrollment targets. The conversion rate this fall will be the data point that unlocks the next phase of the investment thesis.
Through 9 months of fiscal 2026, total revenue is $1.882 billion, up 7.4% year over year. Career learning middle and high school revenue over the same period is up 22.1% to $776.6 million. General education year-to-date is essentially flat, up 0.7% to $1.062 billion. Guidance implies full-year revenue of $2.505 billion at the midpoint, requiring approximately $623 million in Q4, below the $630 million just reported. The math works. The question is whether the business can sustain this momentum through fiscal 2027.
The core investment tension in the Stride story. One business is mature and facing headwinds, another growing at 15 to 22% annually. Career learning year-to-date is $777 million against general education's $1.62 billion. At current growth rates, career learning crosses general education in annual revenue within approximately 18 to 24 months. That crossover, when the high-growth segment becomes the primary revenue contributor, would be a significant re-rating event. The market has not priced it in because execution through the enrollment transition remains the open question.
The net cash position deserves emphasis. With $806 million in liquid assets against $535 million in total debt, Stride sits in a positive net cash position. Enterprise value at the current market cap is roughly $3.4 billion, just 2.0 times trailing revenue for a business generating 27% EBITDA margins. The balance sheet does not require equity dilution, does not face debt refinancing pressure, and leaves management free to prioritize operational execution and opportunistic buybacks. Financial flexibility is a strategic weapon at this stage of the transition.
When you compare Stride to publicly traded education peers, the valuation looks compressed on every metric. Perdoceo Education, Colorado Technical University, and American Intercontinental University trades at 11 times forward earnings with 24% revenue growth, but with Title IV regulatory exposure. Laureate Education, an international higher education operator, trades at 15 times forward earnings. Graham Holdings, a diversified education and media company, trades at 17.8 times earnings. Stride at 11.35 times forward earnings is cheapest in the peer group, despite having a more defensible revenue base.
Stride operates in a fragmented education landscape where direct publicly traded peers are limited, but rivals including Perdoceo Education, Laureate Education, and Graham Holdings illustrate the range of business models competing for the education investor's dollar. Perdoceo's 24% growth commands a premium. Laureate's international footprint adds geographic diversification. Graham bundles education with legacy media. Stride's differentiation is publicly funded enrollment that provides revenue stability no pure market-rate education company can match, combined with a career learning segment competing in the structural workforce skills gap.
The Perdoceo comparison matters because the market often treats all for-profit online education companies interchangeably. But the revenue quality is different. Perdoceo depends on Title IV federal student aid, politically vulnerable and subject to borrower defense regulations. Stride's general education revenue comes from state per-pupil funding, which is more stable and less politically contested. On that dimension, Stride arguably deserves a premium valuation to Perdoceo, not a discount. The market's failure to price that distinction is part of the opportunity.
On the balance sheet, Stride is better positioned than any of its peers. Net cash of $270 million is unusual for a company that has invested in acquisitions and platform upgrades simultaneously. The Galvanize and Tech Elevator acquisitions were funded without meaningful balance sheet damage. Contrast that to education companies that entered the pandemic with significant leverage and have spent recent years deleveraging. Stride begins fiscal 2027 with financial flexibility that competitors simply cannot replicate, and management can deploy it offensively rather than defensively.
Stride's market cap of $3.7 billion against $806 million in cash and securities means you are paying approximately $2.9 billion for the operating business itself. Against a trailing revenue run rate of approximately $2.5 billion and trailing EBITDA approaching $650 million annualized, those multiples are about 1.2 times revenue and 4.4 times EBITDA for the operating assets alone, ex cash. That is deep value territory for a platform business with a growing structural segment and a regulatory moat.
The bear case on Stride is real. Gross margin compression of 380 basis points in a single quarter is significant. It reflects a business investing aggressively in a bet that may or may not pay off. If platform costs do not moderate and enrollment growth does not create operating leverage, the company could face a multi-year margin compression cycle. The adult learning decline of 31% flags competitive pressure in workforce upskilling. If the macroeconomic environment softens further, career learning discretionary enrollment could also slow, complicating the growth narrative.
The bull case is equally compelling. Career learning growing 22% year-to-date with enrollment up 11.6% means the operating leverage is ahead of the company, not behind it. Platform investment ends at some point. Fixed costs get absorbed. Gross margins recover. Add strong application volume for fall 2026, a new enrollment record, a $15 million profitability guidance raise, and a management team that has consistently delivered on its commitments. At 11 times forward earnings with net cash and $806 million in liquidity, the margin of safety is real.
The single most important event between now and the next 12 months is the fall 2026 enrollment announcement. Management typically provides fall enrollment guidance with fiscal Q4 results in late July 2026. Strong application volume suggests the data should be positive, but applications do not equal enrollment. If fall 2026 enrollment comes in strong, consistent with the commentary on the call, the stock reprices toward the $107 to $125 analyst target range. If enrollment disappoints, the stock retests the lower end of its recent range. Everything else is secondary to that print.
James Riew's management philosophy can be summarized in one phrase: optimize for 5 years, not 5 quarters. Platform investment is that philosophy in action. Career learning expansion is that philosophy in action. Balance sheet management, maintaining net cash while funding acquisitions, is that philosophy in action. The enrollment management decisions that drove the stock down were operational lapses, not strategic errors, and the company appears to have addressed the underlying process issues. The strategic direction is clear, consistently communicated, and well-funded.
School choice policy deserves more attention than it typically gets from equity analysts. Approximately 32 states now have some form of education savings account, scholarship tax credit, or voucher program, compared to roughly 15 states a decade ago. These programs directly expand the student population eligible for virtual schools. Federal interest in expanding career-focused learning and school choice at the post-secondary vocational level creates additional regulatory tailwinds. Stride is positioned at the intersection of policy expansion and genuine market demand in a way that took decades to build and is nearly impossible to replicate from scratch.
There is a longer-term technology dimension to the Stride story that rarely surfaces in quarterly earnings coverage. The company has spent years building a proprietary learning management platform, curriculum library, and assessment system. That intellectual property represents embedded asset value not reflected in the balance sheet. As artificial intelligence integrates into educational technology, companies with proprietary content libraries and platform data have a structural advantage over those relying on third-party curriculum. The platform investment today may be creating a technology moat that looks considerably more valuable in 3 to 5 years.
To summarize the quarter, adjusted EPS of $2.30 beat by 4.1%. Revenue of $629.9 million came in essentially in line, up 2.7%. Adjusted EBITDA of $171.3 million beat by 4.4% at a 27.2% margin. Career learning, middle and high school revenue grew 15.9%. Total enrollment set a new record at 244,500. Gross margin compressed 380 basis points, but was offset by SG&A discipline. Full-year adjusted operating income guidance raised at the low end. The company is executing through the transition while managing costs tightly.
The price target bridge. Full-year fiscal 2026 adjusted EPS tracking near $7.90 at the guidance midpoint. Apply the current 11.35 times multiple and you get approximately $89, the current price, meaning the market is pricing in precisely the status quo. If career learning sustains 15% growth into fiscal 2027 and gross margin recovers to even 38% from 36.8% today, adjusted EPS could approach $9.50 to $10. At a modest 13 to 14 times earnings, a multiple still below the S&P 500 average, that implies approximately $124 to $140 per share.
For position sizing, the risk calibration is relatively clear. Stride has a 0.05 beta. It moves on company-specific news, not macro. Downside if enrollment disappoints and margins fail to recover, 65 to 70 near the lower portion of the 52-week range. Upside if enrollment validates and career learning sustains, $120 to $140. That asymmetry, with a net cash balance sheet limiting permanent capital loss risk, defines a favorable risk-reward profile for investors willing to hold through the fall enrollment announcement in July.
Education as a sector tends to be defensive in economic downturns. When the job market softens, demand for workforce credentials increases. When family budgets are tight, free publicly funded virtual schools become more attractive than private alternatives. When uncertainty rises, people invest in skills development. Stride's public funding base makes it less sensitive to consumer discretionary spending than its sector classification suggests. The current valuation at 11 times earnings and 7.3 times EBITDA makes it one of the cheaper defensive growth names in the market with an idiosyncratic catalyst structure.
Stride pays no dividend. All capital return flows through buybacks, $200 million remaining under the current authorization. At $89 per share, that represents roughly 5% of the market cap, real per-share accretion potential if management is opportunistic. The company generated $100 million in free cash flow this quarter alone, meaning it could theoretically fund the entire remaining buyback authorization in roughly 2 quarters of free cash flow without touching the $806 million liquidity cushion. Capital return is an underappreciated lever in the Stride thesis.
Stride's competitive position rests on 4 pillars. Regulatory moats from 40-plus state authorizations built over decades, employer-recognized career learning brands with hiring network effects, a net cash balance sheet with $806 million in liquid assets, and recurring, publicly funded revenue that does not require consumer credit or federal loan access. No competitor combines all 4 at Stride's scale. The stock has taken its punishment. The fundamental position is intact. The upcoming catalyst is specific and time-bounded.
The primary tail risk is federal education policy uncertainty. Changes to how states fund virtual schools, federal funding for career learning programs, or shifts in school choice legislation could impair revenue in ways that are difficult to model in advance. Stride has mitigated single-state concentration by operating in 40-plus states, but a broad federal policy reversal remains a scenario worth weighing. The current administration's posture toward school choice has been constructive, but policy can change, and that risk deserves a place in the scenario analysis.
We have mentioned enrollment repeatedly because it is genuinely the central variable in the Stride model. Revenue is enrollment-driven. State funding flows based on student headcount and attendance. Revenue per enrollment is predictable once enrollment is set. So the critical forecast uncertainty is not pricing, not cost structure, not competition in the traditional sense. It is enrollment. Management's characterization of application volume as strong is the most consequential statement in the entire Q3 earnings call. If it converts, the thesis works. If it does not, the timeline extends.
As we step back and look at Stride in the context of the broader education technology landscape, the company has the scale of a large education provider, the regulatory moats of a publicly funded institution, the growth profile of a career technology company, and the balance sheet of a cash-rich technology firm. That combination is uncommon. The fact that many investors still classify Stride as simply a for-profit education company, applying sector discount without distinguishing its specific model, is the source of the persistent valuation gap.
James Ryu framed the investment case on the earnings call. The macro environment for school alternatives like Stride continues to be a long-term trend that will serve as a tailwind to the business. He is describing a company surfing a structural current, not fighting against one. The headwinds it faces, platform investment, enrollment execution, the adult learning softness, are operational and time-limited. The structural tailwind, school choice expansion, workforce skills demand, career credential growth, is secular and persistent.
One final look at the valuation. Enterprise value of roughly $3.4 billion against trailing EBITDA approaching $650 million annualized gives an EV/EBITDA near 5.2 times on a run rate basis. At 7.29 times on reported LTM EBITDA, still well below the sector median of 12 to 14 times. PS of 1.54 times is the cheapest in the peer group. Forward PE of 11.35 times is at the floor of the comparable set. On every valuation metric, Stride screens as the most undervalued name among its peers, and it has the strongest balance sheet.
3 developments would change the Stride story from value trap to re-rating catalyst. First, fall 2026 enrollment validates the application volume commentary, and headcount comes in strong. Second, gross margin stabilizes at or above 36.8% and begins recovering as platform costs moderate. Third, career learning crosses $1 billion in annual run rate revenue, a psychological and financial inflection that redefines what kind of company Stride is. Any two of these three catalysts materializing in the next 12 months likely drives the stock toward the $107 to $125 analyst consensus range.
For investors positioning into Stride today, the key risk management consideration is the 90-day window to the fall enrollment announcement. The stock is likely to trade in a relatively tight range until that data lands in July. Position sizing can reflect the asymmetry: downside of $65 to $70 with balance sheet support, upside of $120 to $104 if the thesis validates. Investors who enter here and hold through the enrollment catalyst are buying a specific binary event, with their entry point protected by one of the stronger balance sheets in mid-cap consumer discretionary.
Stride typically provides fall enrollment guidance with fiscal fourth quarter results, expected in late July 2026. That is approximately 90 days from the current date. In the interim, there may be commentary from management at investor conferences or in other public appearances. Watch specifically for the enrollment guidance range they provide, not just whether it is higher than last year, but whether the growth rate in career learning enrollment accelerates, maintains, or decelerates from the current 11.6% trajectory. That rate tells you everything about the medium-term revenue story.
To close the peer comparison, Stride at 11.35 times forward earnings is cheaper than Perdocio at 11.09 times, but with a meaningfully less exposed regulatory profile. Cheaper than Laureate at 14.93 times with comparable or better growth, and significantly cheaper than Graham Holdings at 17.77 times, which has no equivalent growth story. On EV, EBITDA, and PS, Stride screens last in the peer group for price, but first for balance sheet quality, and arguably first for regulatory stability of revenue. The valuation rank appears inverted relative to quality rank.
Looking into fiscal 2027, the career learning narrative gets structurally stronger. More state CTE program approvals are in the pipeline. Tech Elevator and Galvanize are expanding into new markets. Employer pre-hire partnerships, where companies commit to hire students from Stride's programs before they enroll, create a flywheel that drives both enrollment demand and outcomes simultaneously. As placement rates remain high, word-of-mouth enrollment grows. Marketing cost per student falls, unit economics improve. The virtuous cycle is building, and it has not yet been reflected in operating margins.
The Stride thesis is a bet on three things: that virtual public schooling has a durable, addressable market supported by school choice policy expansion, that career learning can sustain its growth long enough to become the dominant revenue contributor, and that the management team can execute the platform transition without permanently impairing profitability. At 11 times forward earnings with a net cash balance sheet and a record enrollment quarter just reported, the market is pricing in a great deal of uncertainty. Investors willing to hold through the fall enrollment catalyst are being paid to take a well-defined, time-bounded risk.
The key metric to track: career learning enrollment and revenue growth rate in fiscal Q4 FY2026, announced in late July 2026. The 11.6% enrollment growth and 15.9% revenue growth this quarter set the baseline. If the growth rate holds or accelerates consistent with strong application volume, the thesis is intact and the stock moves toward the $107 to $125 analyst target range. If it decelerates meaningfully, the market will reassess whether career learning can carry the overall business. Watch that single number in late July.
If you're looking to summarize the Stride opportunity in one sentence, you are buying a growing education technology platform at 11 times forward earnings with a net cash balance sheet of over $800 million, where the fall enrollment confirmation in 90 days is the specific catalyst that unlocks 20 to 40% upside toward analyst consensus targets, and the business keeps generating cash while you wait.
Stride Incorporated reports quarterly results against a fiscal calendar that runs June to June, but the investment calendar is simpler. July 2026 is when the fall enrollment data lands. Until then, the company is executing on its operational roadmap: career learning expansion, platform investment, SG&A discipline, and balance sheet stewardship. Q3 FY2026 showed that the company can beat on EPS and EBITDA even while investing through the margin compression cycle. That is a management team that has earned patient capital.
That wraps up our deep dive on Stride Incorporated, ticker LRN, for the January through March 2026 period. If you follow Stride, mark your calendar for the fiscal Q4 earnings call in late July when the fall enrollment data lands. It is one of the cleaner binary catalysts you will find in mid-cap equities this year. As always on Charged Alpha, we are building the S&P 500 company by company, episode by episode. Keep watching.
Before we sign off, a quick disclosure. Nothing in this episode constitutes investment advice. Charged Alpha is an educational and informational program. All data referenced is sourced from public filings, earnings releases, and analyst research as of April 28, 2026. Stock prices, estimates, and ratings change continuously. Please do your own research or consult a qualified financial advisor before making any investment decision.
Thanks for joining us on Charged Alpha. If you found this analysis useful, please subscribe on YouTube or your favorite podcast platform, leave a review, and share with someone who wants real analysis on S&P 500 companies, not headlines, but the actual numbers. We will see you in the next episode.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.